Whenever world oil prices rise or fall, Canadians feel it. The latest conflict in some far-off part of the world causes new havoc on the paper futures markets that govern oil prices, and that translates into higher bills here at home. But Canada produces far more oil than it uses. 80% of our oil is exported, mostly to the US. So why do Canadian prices ride that same roller coaster? And what can we do about it? I'm Jim Stanford. I'm the economist and director of the Centre for Future Work, sponsor of False Profits. Let's dig into it. Canadian energy policies allow oil and gas companies to charge us those same global prices, even on energy produced, processed, and consumed right here in Canada. In fact, when oil prices spike, we usually see it in higher gasoline prices in a day or two, even though the gasoline in the pump was produced and refined weeks or months earlier. Now keep in mind, prices are always much slower to come down whenever futures markets cool off. Up like a rocket, down like a feather. That's how prices work, it seems. Here's a recent painful example. Early 2022 saw a price spike in the world oil price. It rose 65%, hitting $130 US per barrel. That oil price spike was the biggest single factor behind the surge in inflation that we experienced around the world. In Canada, for example, our inflation peaked at 8% by June that same year. Now, the world was experiencing a lot. COVID lockdowns had just ended. The world economy was opening up again. Russia invaded Ukraine, a country that, by the way, does not produce oil. Because of all of this, speculators gambled on the price of oil going up, and the resulting demand for futures contracts, not for oil itself, drove the price higher. So, in turn, Canadian oil and gas prices shot up too, over 50%, thanks to a paper panic caused by a conflict on the other side of the world, with no relationship whatsoever to Canadian oil supply and demand. In fact, Canada was producing more oil and gas than ever, but Canadians were paying vastly more for it. Once it became clear that the invasion of Ukraine had no impact on world oil supply, the futures price came crashing back down. By the end of 2022, it was back to $80 a barrel, right where it was when the year started. But the damage was done. Inflation had taken off around the world, consumers were struggling to pay their energy bills, central banks were hammering us with high interest rates. Our research shows that higher oil and gas prices were the biggest single cause of the inflation that caused so much pain across Canada in 2022 and 2023. Thanks to that price spike on futures markets, Canadian households paid almost $200 billion more over the next 3 years in higher prices, higher interest costs, and lost employment income. That's $12,000 per household. Now, prices have come down a lot since then, but oil prices are still set the same way. What we pay for real oil and gas here in Canada is determined by the mood swings of financial gamblers playing a big casino on the other side of the world. The oil industry loves it because when the roller coaster is going up, they make record profits. Close to $200 billion profit for Canadian oil and gas companies from 2021 through 2024 alone. This pointless roller coaster in paper futures markets caused real pain and economic destruction around the world, including here in Canada. But it doesn't have to be this way. Canada could use regulations and circuit breakers to limit how much futures prices fluctuate, and use taxes and regulations to limit how much money flows into those paper casinos. We could buffer the links between futures markets and the prices in our own domestic energy markets. We could limit how much and how fast energy prices can change. We could regulate prices on the basis of actual production costs. Most provinces already do that with electricity. Electricity prices did not shoot up the same way in 2022. If the roller coaster shoots up again and prices become ridiculously high, then we can protect consumers by clawing back super profits through royalties and taxes, and then offsetting the energy costs of households with rebates to consumers, especially for those with low incomes. In the long run, the best way to get off this roller coaster is by accelerating the transition to renewable forms of energy. There's no futures market for sunshine, or wind, or geothermal, or hydropower. Those sources of energy are now cheaper than fossil fuels. They're produced here, not on the other side of the world. Their prices can be stable, and of course, they prevent climate change. So, it's not a question of if another ride on the roller coaster will occur, it's a question of when. And given all the geopolitical conflict, war, and uncertainty in the world today, that next ride will happen sooner rather than later. So let's get off this roller coaster once and for all.